We take the pulse now of the market with a bull and a bear. Our bull today, Ted Parrish, co-manager of the Hensler Equity Fund, and our bear is Peter Schiff, president of Euro-Pacific Capital. Gentlemen, nice to have you with us. Welcome to the program.
Hi, Maria.
Peter, I'm just looking at some of your notes after speaking with our bookers today, and you said that the U.S. economy is a house of cards that will fall apart. Explain.
Well, it's literally a house of cards when you see that it's built on the foundation of a housing bubble. But I've talked about it on many occasions on your program. But the problem with the U.S. economy is that we are consuming, yet we're not producing. We're borrowing, but we're not saving. And we're running up record amounts of debt to foreigners, and we're financing nothing but consumption. And that is an unsustainable accident waiting to happen. And I think the surge in the price of gold and other commodities is indicating that this is finally, the chickens are finally coming home to roost.
The bottom line is?
Bottom line is I'm a big bear on the U.S. stock market. You know, the Dow Jones already is down 20% year to date, priced in gold. That is a tremendous loss of purchasing power. The Dow has lost better than 60% of its value since its peak in 2000.
Sounds like good management to me. Sounds like good management of the economy to me. It's just like a corporation. You know, if we have a huge deficit, I mean, we're making money on the money we're borrowing more than the people who are getting for lending it to us.
No, we're not.
Like corporate America.
Well, you know what? I do have a problem with the savings rate, the way that you say it, because the savings rate really hasn't been updated in years. I mean, the savings rate, it says that we have a 0% savings rate, but that doesn't even include the 401ks, right? It doesn't include retirement savings. I mean, it doesn't include so many things that are obviously savings vehicles.
It includes what it's always included, and it includes the same things that other countries have in their savings rate, and our savings rate is actually negative. And you know,
well, no, it's not negative. No, it's not negative.
Well, sure,
Maria's right. It doesn't include 401ks and all the pension money that's saved up.
I mean, that's a big point.
Fine.
But I don't want to get too far into this discussion about what the savings rate is saying or not saying, but it definitely does need to be updated. Let's talk about the fundamentals of the market. Ted, how do you answer Peter's comments here that in fact there are some negatives out there and he's real bearish on the stock market? I mean,
there are always negatives out there. The fact is there are more negatives abroad than here in the U.S. The emerging markets are overvalued. Commodities are overvalued. The U.S. equity markets are the cheapest. Where else are you going to invest? We offer the best potential returns going forward the next 3 to 5 years.
Well, I
think growth is going to be good.
What about that, Peter?
Well,
I mean, if not the United States, where are you putting your money?
Well, we've been investing exclusively outside of the United States, you know, and for the past 6 years, the returns have been phenomenal compared to the losses that investors have sustained over that time period here in the United States.
That's right.
The U.S. market, though, remains extremely overvalued. The dividend yields are lower. The PEs are higher than what we're finding abroad. And the problem is with the U.S. dollar. The dollar is, you know, in serious danger of losing a tremendous amount of its value. So when you're trying to have investments...
Where's that money going to continue to go, Peter? Is it going to go into commodities?
Well, it's going to leave the dollar.
If it continues to go into commodities are going to have a big fall coming because they don't earn money, Peter. I have clients who actually buy investments that they expect a return on, something that's value building, value creating. Gold doesn't create any value.
Let me ask you this. What changes your opinion, Peter? I mean, what would you like to see happen to actually get you to reverse course?
Well, you know, as I said, I've been bullish on gold for, you know, a number of years.
Now, I'm talking about the stock market.
Well, I've been bearish on the stock market, but you know, most NASDAQ stocks don't pay any dividends either. I mean, people say gold doesn't have a yield. Well, neither do most stocks in the NASDAQ.
Right. So the question is, what would change your mind on this?
Well,
what would reverse your scenario?
Well, we need to have a real recession in this country. We need to purge the imbalances of both the NASDAQ bubble and the consumption bubble of the last few years. We need to see a real retrenchment. We need to see a significant decline in the stock market, in the bond market, in the real estate market. And I think gold and other commodities need to be a lot higher.
You're going to be waiting around for a while because I don't think that with the economy growing and the dollar decreasing in value is actually going to help our companies abroad. I mean,
no, it's not.
And
the economy is not growing.
The economy is growing.
No, it's not. Maria, what's growing is our consumption and our debt. We're not growing a real wealth. We're not creating more, you know, manufacturing, wealth-producing industries. All we're doing is borrowing money to consume.
You mentioned housing earlier, Peter, and if you look at other countries like London, for instance, their housing market is more valuable than ours. You're paying at least 40 or 50% more per square square foot for a house in London than
well,
you are in the States.
I will agree.
You're saying our market's overvalued?
Look, I'm not saying that the United States is unique in having an overvalued housing market. I think that's one thing that much of the English-speaking world has in common. The difference is our economy is based on our housing bubble. Our consumers are spending based on home equity extractions, and we are relying on interest-only mortgages.
Not everything is reliant on housing. Let's face it. Corporate earnings are growing. Corporate balance sheets are better than they have been in years. But clearly, this is a debate that ought to continue, gentlemen. Thanks so much. We'll have you back soon. Peter Schiff and Ted Parrish on the market.